All right. Hello, everyone. Safi Russell here from SDR Consulting, founder and CEO. And we are here for Business Basics Friday. Business Basics Friday is a weekly session with topics that can provide value to business owners. And we have two guest speakers today. So let me give you a little background about myself first. I've been in the industry about 19 years, and I am a CPA and enrolled agent, and also have a master's in taxation. SDR Consulting is a virtual firm. We are based in New York, but we work with clients all over. And we mostly work with businesses, helping them from the startup phase all the way to cleanup if they need that, as well as tax preparation. And so today we are going to be discussing tax season checklists, individual edition, to provide some tips and suggestions ahead of tax season. It is January of 2022. So happy New Year to everyone and happy tax season. And so we have two guest speakers today. The first speaker will be Kamari Ellis. And Kamari, when you're ready, you can go ahead and come on board and we'll go ahead and get started. And we will have an open Q&A session at the end. So if you do have questions, whether you're here on Facebook or on Clubhouse, whether you're in the Facebook page or group, I'm going to be managing those questions by text or in Clubhouse via audio. So write them down, and at the end, we will open up to questions as it relates to tax and accounting. All right, I'm going to turn it over to Kamari, and the floor is yours.
Good morning, everybody. Happy New Year. Thank you for having me, Safi. I always appreciate jumping on with you and tapping in with you. But let's get right into it, right? We're talking about the tax season checklist for individuals. The portion I want to be talking about is business owners and the folks that are running rental property and things like that. But I want everybody to know, right? If you're working your business, if you're working a 9 to 5 and let's say you get a 1099, whether it be a 1099 NEC or a 1099K, you are a business owner, right? So you have to act accordingly. You get the benefits of a business owner. So you could be a freelancer, Uber driver. You could even work a brick and mortar business, but a lot of people don't realize that they're business owners when they get these forms. And so I say all that to say, make sure that you're taking all the proper expenses and deductions, right? Whether it's writing off your cell phone. Now be mindful that if you just have your personal cell phone and you don't have an actual business cell phone, you might want to be really, really careful with that. You don't necessarily want to write off all of your bill when taking that expense, because if you're ever audited, the IRS is going to say, hey, this is also a personal phone. You don't have a separate business phone. I'm sure there are some personal phone calls you make on that phone. So you want to be careful about that. I normally say take about 50% of that deduction or that bill as your deduction, right? So, you want to keep all those things in mind. One of the big things I'm seeing people that either have a side hustle, gig work, or even have, a regular business that's online and e-commerce, they're not doing good books. And so again, you're a business owner, you get to take off all the write-offs, all the expenses. But the best way to do that, to make sure you're not paying too much in tax, is to make sure that you're keeping good records. So if you brought something, it's January right now and you're in business. If you brought something in January, by the time we get to next January or next February of 2023, you might have forgotten about it. But if you have a good bookkeeping system, what we might call it an accounting system, you are able to track that down. And being able to track that down, you're able to keep a record of everything that you spent and then make sure you write it off properly on your tax return. So some of the things you want to keep in mind when you're a business owner, again, if you're paying any rent anywhere, if you're using any tools or equipment in the production of your good or service, you want to make sure you write that off as well. Any insurances that you might pay, you want to write that off as well. Any licensing fees that you might have to pay, you want to make sure you keep a good record of that and write that off. So again, we're talking about this upcoming tax year. Tax folks will call it the 2021 tax year. Average everyday people will say the 2022 tax year because we're in 2022, but we're filing 2021 taxes. So if you haven't done any of this bookkeeping, now is a great time to go back, categorize everything, well, one, gather everything, make sure you're not missing anything, categorize it, and make sure it's reported properly on your tax return. You want to take all your benefits. Now, the other thing, which is very tied into businesses, right? If you are a real estate owner or real estate investor, I still say you're a business owner, but it's a little bit different. And again, people don't necessarily always think of themselves as business owner just because they have a rental property, 2, 3, 4, or 5. I have some clients that have 20 plus rental properties. And some of them struggle again with what? Bookkeeping, right? So that is the central theme. I don't think people really realize just how much power it is in being organized and being able to print out a report of all your expenses at the drop of a button or at a push of a button. So for my rental owners, my real estate owners, do the same thing. Make sure you're categorizing all of your expenses, right? One thing I see a lot of real estate investors miss out on is what's called depreciation. And so when they buy these properties, a lot of times they do not capture what they bought the property for. So as an example, let's say they bought a property for $100,000 just for easy math. You can't write that whole $100,000 off in the year you bought it. What depreciation allows you to do is spread that expense over usually the life of the property, on average 27 and a half years if it's a residential property, 39.5 years if it's a commercial property, not to bore anybody with the technicals. But you get to take that deduction year after year after year after year. But a lot of times we don't log it, or my clients don't log it in the beginning. And so they miss out on all that. And here's the thing, but a lot of people don't realize the IRS makes you take it whether you realize it or not. Because when you sell that property, or if you sell that rental property, there's a thing called dividend recapture. And they'll go back and calculate all that and add it in, because you have to add that in when you're selling the property. So again, take a moment, go back, capture all your expenses, look at all your paperwork, get really, really organized, because if we're talking about creating wealth, one of the best ways to do it is through a business and real estate investing, or real estate investment. And the best way to maximize that is by being really, really organized, keeping really, really good records, and having them in a place where you can create reports and give them to the bank officer, whether you need a loan or a mortgage, being able to keep reports so you can look back and say, am I managing this business or these properties well? Going back and creating reports so you can do your taxes really, really easy and really, really simple. So it's not a big deal and wait towards the end of the year. Also, I said do taxes. The other thing you want these reports for is so you can do tax planning and tax strategy, because a lot of times it's hard to try to implement something that you're not tracking, so you don't know where you're at. It's hard to look at projections of a thing where everything isn't organized. So again, I would say get really, really organized. Have a system, whether it's QuickBooks, Wave, Zero, whatever it is you use, just really get masterful on it. Even if it's a spreadsheet, just be really, really dogmatic about using it, staying up to the date on it. While it might be a pain in the butt now, it's going to pay dividends, multiple dividends, as the years go on. But that's all I have today, Safi. Please go on up and let us know what we're to do next.
Thank you, Kamari. That was definitely helpful, and we'll definitely expand on that and chat a little bit about it. We all have such interesting experiences, right? And so our goal is to go through these things with you now, and so you can get a head start for tax season. So thank you for sharing that. And so next up, we have Atia Brown, who's going to share her tips on this upcoming tax season and what to be prepared for. So Atia, the floor is yours.
Hello, everyone. So my name is Atia Brown. I'm the owner of the Savvy Accounting Firm, and we love all things taxes. So I want to take this time, since we're talking about how to get ready for the current tax year, and I want to talk about some things that happened in the past year to lead us to this year and to what my topics are going to be. So last year and the year before, coronavirus hit, and it was really bad. the government ended up giving stimulus payments. And so this was to kind of have economic relief for some of the taxpayers. So what happened was this was actually a credit that was given in advance. And so what was supposed to happen was you were supposed to true it up on your current tax return and what you received versus what you should have received, because since your tax return wasn't filed, they had to be basing it on prior information. Well, the government had to issue something like 7 million notices because there was a lot of errors with the reporting of what came with the stimulus payments. And so in order to try to avoid that this year, what the government is doing is in January, you're going to be receiving 2 letters. These 2 letters are very important. So the letter 6419 is going to be for, well, I'll start with 6475 first. So that's going to be the letter that you receive that's going to show your reconciliation for your stimulus payments. So what you receive for your rebate recovery credits, that's going to be shown on letter 6475. So you're going to want to make sure that you have this letter, because any stimulus payments that you received in 2021 needs to be reported on your 2021 tax return. They need to make sure that you qualify to receive the stimulus, that you receive the correct amount, and then true up anything that needs to be fixed. The second letter is going to deal with the child tax credit. So in 2021, the government, trying to help families because the coronavirus was still present, they started to issue child tax credits in advance. And so what that means is you were getting monthly payments for your child tax credits, and you need to true it up on your 2021 tax return. So because they were basing this on prior year information, your income could have changed, your qualifications and requirements for you to hit to actually receive this child tax credit, it could have changed. And so the letter 6419 is going to be sent to you in January, and that's going to be showing what you received for the child tax credit, and then you're going to compare that to what you should have been receiving for the child tax credit for the year 2021. So what you need to do with these 2 letters is you need to take them to your tax preparer and make sure that you give it to them so that they can report what you actually received versus what you should have been receiving. We don't want to have to miss out on these letters and report what you think you received, because what I noticed with a lot of the taxpayers last year is when it came to the stimulus payments, they were probably thinking they were supposed to get kind of like whole numbers, but some of the numbers could be prorated. So some of them missed that they actually got stimulus payments because they just weren't expecting that amount. And so they forgot to tell their tax preparer about it. So these letters are supposed to help in that situation. So on top of what Kamari was saying, how what you want to make sure that you're not missing out on in terms of deductions, you want to make sure that you're not missing these letters so that you can report the actual amount and not have any issues, not have the government have to send you a notice telling you what you missed out on. And so those are the topics that I wanted to talk about to let you guys get ready for tax season so that you're not surprised when you get this letter in the mail from the IRS. It's really just your reconciliation for the child tax credit and for the stimulus payments that you received.
Perfect. Excuse me. Thank you, Tia. And yeah, it was some returns are still held up now, right? Because of those miscalculations and stimuluses that were on the 2020 return. And so when you want to, if you're getting a refund, you don't want any delays in that. And it's not your tax preparer's fault that your refund is delayed. If the information doesn't match, it will delay your return because the IRS literally has to manually look at your return, reconcile what should have been right, fix it, and then send you a notice. It's a process. So there are plenty, millions and millions, I forget the count now, of returns that are still not prepared, not posted yet, from 2020 due to this issue. So I'm glad the IRS is coming out with this letter. I'm hoping that your address is up to date, so you get the letter, right? A lot of people move and they don't change their address. It's going to go to your last address on your return. And then if not, you can get it from your IRS transcript. But getting on that website, irs.gov, and getting into your account is a whole nother discussion, right? So there is that other way to get it. And so if you don't get that information, your taxes can't be properly prepared. We as professionals could help you get it, but it's going to be a separate fee because we could get those transcripts. We have to contact the IRS. You already know about hold times and such. So save yourself some money, keep the letter, don't throw it away, or get access to your online account at irs.gov and have those amounts ready. So thanks for sharing that, Atia, and Kamari. Thanks for sharing. I'm just gonna comment on something that you mentioned, and then I'll share my 2 points with the rental. Like you said, many big people may not realize they're a business owner. People don't realize they are landlords or that they have rental property, right? You do Airbnb or VR, whatever the other one is, or you rent your basement out to your cousin, whatever it may
Yes,
be,
yes.
right? You have a rental property. It may be a portion of your home, maybe a room in your home, but those same rules and benefits apply. If you're exceeding, the 14 day, there's another rule out there. If you're only renting for 14 days or so, then you don't really have to factor these in. But if it's more than that, then as soon as you rent out that space, more than that 14-day time frame, whether it's your whole home, a portion of your home, those rules apply to you. All right. So my 2 topics I'm going to share briefly are extension filing. So the first one being extension filing. If you are unable to get your taxes filed in time because you're maybe waiting on documents, you have investments, maybe you just, got a lot going on, you do have the option to extend your return. So whether it be a business return, if you're a corporation, S corporation, or a partnership, that deadline is March 15th generally. And by extending the return, you would have until September 15th. If you're an individual, the deadline hopefully stays the same, but it's usually April 15th, and you would have until October if a proper extension is filed. An extension only gives you more time to file. It doesn't give you more time to pay. So if you're expecting to owe, or if there's any minimum fees that are due with your business tax return, those still need to be paid by that March 15th or April 15th deadline, because if they're not, there's some states where your extension won't even be valid. And then there's other situations where you may get that extension, but now you're going to be hit with late payment fees on the taxes and be charged interest starting from your original due date. So if you at least have a ballpark idea of what you're going to owe, you want to make sure you pay that amount with your extension filing. So we're in January right now. We got the first deadline coming up. Well, we actually have a deadline coming up this month for payroll and 1099s, but for tax return purposes, the first deadline is March 15th for certain business types. You want to be thinking about those extensions now, find out what you need to pay, just get it out the way if you know you're not going to have enough time to get your complete filing done. So that's for extensions. The other thing I mentioned was deadlines. We went over that already. So April 15th, May 15th, I'm sorry, March 15th and April 15th, depending on your structure. And then lastly, tax season opens up at a certain date, right? So the IRS is opening up for business returns starting next week. And that's going to be for business returns, corporations, S corps, partnerships. Individual returns, I don't know the date yet. If Atia or Kamari, have heard that date yet, it's usually roughly around the 20-something of January. This means your return can't be sent in until then. It can start being prepared depending on the preparer you're working with, but the filing can't start until the IRS actually opens up e-filing. And also, you're going to want to wait for your documents. You don't want to start trying to rush and filing with pay stubs and things of that nature. There's differences between those statements and your W-2. Just wait for the W-2. All of those documents generally should be to you by January 31st. So there's really no point in rushing. Okay. So those are my takeaways: extension filing and deadlines, as well as the upcoming availability to file. So just get all your documents together. You don't want to start missing information because you're rushing to file. Hopefully you're working with a tax professional who has some type of intake form or organizer that will guide you through questions that would help jog your memory for what you actually had last year. We all had a lot going on. The current pandemic still being here. So you may have forgot you had unemployment or only had it for a month or two. And all those documents, some of them, they don't even mail them. You have to go online and pull them. So you want to be sure your filing is complete. Hopefully you have some type of checklist or intake form to do that. All right. So I'm going to go ahead and bring everybody back. We're going to open up for Q&A if there is any. So if there's anyone here on social media or Clubhouse that does have a question, you can feel free to raise your hand or comment. And Atia, Kamar, if there's anything you guys want to add on, we can definitely continue chatting.
Regarding IRS process times, I know you just touched on that. The IRS is saying they are back in processing regular returns, but I don't quite believe them. I will say this though: the IRS is also reporting that their amended returns, their 1040Xs, they still have 2.3 million that are unprocessed. So it's important to try to do your return as accurate and as precise as possible first go round, because if not, it's going to take forever for the IRS to process those returns.
Absolutely. Absolutely.
Yeah. And they also they released a statement, I think it was on December 21st, that they're estimating that they're 20 weeks behind in processing amended returns.
Wow.
And
wow.
But from what I've seen, it's been more like 6 months.
Absolutely.
So I think that they're being generous with their estimates.
Agreed. Because normally it was like a 4-month minimum, and then once COVID hit, forget it. I mean, it's been a year and a half, in some cases.
Yeah.
Okay, we have a comment or question here on Clubhouse. So let me get this to work. Okay, Kay, how are you? You go ahead and ask your question. Happy Friday. All is well, thank you. Okay, Kay had a question about the depreciation recapture when you sell your property. So I think, Kamara, you mentioned that. If you want to share a little bit more on that.
Sure. Kay, thanks for the question. So a lot of people don't realize, one, that you have to take depreciation on the property that we talked about. And also when you sell your property, you have to add that depreciation back in. So let's the best way I can explain it. Let's say you sold your property for $100,000. Let's say you depreciated $50,000 of that property over the lifetime or over the period. That $50,000 then gets added back into your overall sale price when you are factoring it for tax purposes. So, the government's very slick. They want you to be a long-term owner. So they incentivize you to be a long-term owner, whether it's from tax rates, whether it's from depreciation rates. And so, those are things you have to think about when selling a property.
Yeah, and it's so weird. I don't know the theory behind it, but it's kind of like a temporary deduction over time. And then you got to add it back, because what's the point? I don't know.
Well, technically, it's only a temporary deduction if you sell.
Yes.
If you own forever, which the government encourages. So remember, right, everybody that's listening and watching, taxes are used to incentivize positive economic activities for the country, and taxes are also used to disincentivize negative economic activities, right? So we all know real estate is one of the most favorite tax class or asset classes in the tax code. Why? Because when people build properties, they're hiring, they're buying lumber, they're buying other materials. It impacts the economy in a lot of ways. So they want to discourage that a lot of times. So that depreciation factor or recapture rather is, I would think, their way of disincentivizing folks from selling. But here's the thing, nobody talks about it.
Nobody talks about depreciation recapture, I think, and people don't realize that depreciation in itself, it's a non-cash deduction. And so it's a benefit that the tax code gives you for not actually paying for something. So you didn't pay for that asset. You paid for it when you purchased it. It became an asset, but that depreciation that you get year after year, it's not something you had to pay for. So you're just getting that extra deduction that's reducing your taxes. So if you want to look at the government as a business, they're giving you this benefit where you reduce what you pay to them, but when you sell it, you're getting this windfall of cash, is what I think what the government looks at it. When you sell a property, you get a windfall of cash. So they're like, well, we should get a benefit of giving you all of those deductions in the past year where you didn't pay taxes on it.
Very interesting. Very interesting.
That's my take on it.
Yeah.
And by the way, right, Congress regulates the IRS. I tell folks, Congress is the IRS's daddy. So when folks get mad at the IRS, the people you really should be mad at is Congress. And we all know Congress does not have the best economic, financial, and accounting education and experience. So some of the things are a little squirrely because the folks that put these people, or the folks that are making the laws, a lot of times don't have the experience and acumen to truly put these things into law. But I'm not going to make this a political thing. I'm just saying.
Yeah. Thank you for that. And it only applies if the property is sold at a gain. So if your property is sold at a loss, then that recapture may not be an issue. And there are ways to avoid it of course, holding it long term, but if you could do a 1031 exchange, that's another way to kind of just roll over your gains and, the recapture issue into another property. So, everyone's position is different. Some people are just have to, they have a property, they need to get rid of it, and they have to chalk it up. But if there is a way to kind of extend that out, that's one way. Keep it or do it another exchange.
Right.
Yep.
Perfect. All right, Kay, did I answer your question? Any other questions you had? Mm-hmm. Good question. She said that if you're not taking depreciation, then there wouldn't be anything to add on. And Kamari, I'll let you go ahead and take that since that was your topic.
So technically, the IRS will still add it in if you were ever audited, right? So I guess we're going to talk real facts here, right? The probability of you being audited is like slim to none. But here's the catch: when you get audited, it's a mother. So I always say, be prepared for the worst, and be able to defend against it. Again, as everybody echoed on the panel, a lot of people aren't taking depreciation. A lot of people aren't reporting the depreciation recapture because they don't know or their taxes have been done incorrectly. But if you were ever audited, they're going to say, you didn't take depreciation. We don't care. We will calculate what it should have been, and then we will factor it in for you. So it's almost like you're now the kid that has to eat the vegetables that the parents are making you eat that you don't want to eat. And you're trying to spit it out, but they don't care. They're going to make you eat it either way.
The accuracy. Yes.
I was going to say, those analogies are funny.
Right. I'm sorry, Kay, what'd you say? Yes. 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 You're welcome. She said that when we owe money, we have to go pay back all the way back to like 1800. But if they owe us money, we only get 3 years. And she's right. So yes, you should take it if you haven't. And if you haven't taken it, depending on how long it's been, you may need to do an amended return, or you may need to actually do a special form, a form 3115, to make the adjustment cumulatively. So it is something that could be fixed. You do need to fix it from the beginning whenever you do catch it. And it is something that's unfortunately not every professional is aware of. So you may pick up a return from someone else, and then you're like, wait a minute, I see rental property here, but I see no depreciation. Well, you got to go back to when you first rented that property to fix it.
And let me just jump back on that, right? Because we know when IRS looks at anything, they always look at it in the worst case scenario for the taxpayer. But oftentimes, like, you having good records will help minimize any burden or any pain that the IRS is delivering to you. So if the IRS has to go back 20 years and try to figure out what your property was bought for, they're probably going to estimate on the lower side of things, but they may not factor in all the capital improvements that you did. You might have put on a new roof, got new plumbing in, got new electrical in. All those things should be added in to your overall depreciation as well. But they might not add that. They'll just say, boom, you only paid $20,000 for this rental property, when in fact it took you $100,000 plus the purchase price to get it up and going. So I always tell folks, want to keep good records. We are in the age of electronic and digital now. Keep them all, just keep them really well organized, and just stay prepared. Stay ready so you don't got to get ready.
Yep.
Agreed. And you do want to keep them forever, honestly, especially if you have a property, because yes, they have a certain amount of time to go back generally. But when we're talking about rental properties, your deductions currently relate to when you first started. So the depreciation, other adjustments to basis and things like that, for partnerships. So just keep everything, keep it electronically. I just keep everything.
Yeah, and it's good to note that we talk a lot about federal, but state laws are very important, because some states require you to go back as far as you can. So California, if you have several years of unfiled tax returns, while the federal might say 6 years, going back and amending 6 years is fine, California is going to tell you they want all of those returns filed. And so you want to make sure that you know your situation and have records that are going to substantiate your situation.
California's like a gang. They don't care.
I mean, them in New York, they're kind of
New York,
tight.
no, New
I'm not
York's
gonna
rough too. New York's rough too.
Yeah, I could agree. I could agree. Yeah, the states are a whole nother level. So yeah, each has their own criteria. And then, when it comes to depreciation, there's certain incentives on the federal level that may not apply to the state as well. So that's why the record keeping is just vital.
Yeah.
Absolutely. Absolutely. All right, Kay, you all good? Any other questions? Okay, you're welcome. You're welcome. All right. So move her back to audience. Okay, we're open for Q&A. If anyone else has a question before we wrap up, someone has a question on Facebook, but they haven't posted it yet. So if you're listening, we're going to shut down in a few minutes. Go ahead and post your question, and and we'll go from there. So with the credits that Atia talked about, the advanced child tax credit. So if you were in a situation where you, like you said, your income changed, or if you had a child you had a child in 2021, they wouldn't know about that. They never actually updated the portal to make changes. I don't think they were supposed to, but anyway, whatever you didn't get in 2021 because you had an extra child, or because maybe your income for a previous year was too high, that adjustment will be caught up on the tax return. So the recovery rebate is pretty much like the stimulus that you didn't get. So when you're working with your tax preparer, just, the terminology can fluctuate amongst people. So just be sure you're clear on how much you got upfront throughout the year, which should be on that letter or on your transcript. And then on your return is where the balance of the credit will show up. And if that credit is not right, that's how your return can get pushed back and held up for refunds and recalculated by the IRS. As it relates to children, I also want to mention child and dependent care credits, because I think since the pandemic, depending on your situation, maybe you didn't have childcare the same way you did in the previous years, or maybe you did, because this, people started opening back up this year. You want to be sure you get the summary letter of what you paid for the year, as well as the EIN or social security number of the care provider. Because if you're paying X amount of dollars in childcare, the credit isn't huge. I think it's recently gone up, but nonetheless, you can't claim it unless you have that information. So, that should be something that your provider should be given to you, or you may need to ask. You want to have the EIN, name, address, or social, and the total amount you paid in childcare. It could be summer camp, it could be after school, or a daycare. So speaking of children, that's a credit that could add up. Anyone else have any other tips that came to mind?
I'll say this: file your taxes as soon as possible. For some of the reasons that we already stated before, but you do miss out. Again, we talked about the refund, the 3-year look back. You do miss out on a lot of things because you didn't file. The IRS also, because I see a lot of people do this, they'll file 1 year, then wait another 5 years to file. The IRS loves to order people that do batch filings. So I would say just start getting the habit of filing on time. If you got to take the time to get your stuff together and you need to do an extension, that's cool, that's fine. But try to file in the current year that you're doing. It'll also help minimize any penalties and interest that you have. Again, I said California is a gang. The IRS is like the mafia. And so they exact paying, well, actually both of them are pretty bad, but they both exact paying really, really well. Their interest rates are like crazy. And the penalties and fees that they issue are crazy, in my opinion, as well. But we all have to render upon Caesar what Caesar is due. And sadly, Uncle Sam is Caesar in this case. So just get him out the way and get him out the way early.
Agreed. And, just be careful with who you choose to prepare your returns this year, right? Whether it's the tax law change, or whether it's, the credits, or whether it's the rental property, or you're a business owner, not every preparer can handle those things. And I'm not going to say you need to go with credentialed only preparers, because some of them could be a mess too. You just want to do your due diligence. We are CPAs and EAs here. We've gone through extensive training and continuing education to stay on top of these rules and maximize the legal deductions and credits that you're eligible for. Others out there may do this as a side hustle, and that's cool. maybe they haven't taken as much training or put the time and the dedication in, and they're just going to literally take your numbers and put them in the software. So just be really careful with that. Also, if you have a preparer that you paid to prepare your taxes, they should be signing the return. There's a lot of times we get returns, oh, someone did it for me, and it says self-prepared on it, i.e. that is a way for them to not be accountable for that preparation of the return. And they're saying you prepared it, but really you paid someone and they don't want to be responsible. So key things to look out for when it comes to choosing a tax preparer wisely. And Kamari and T, I'm going to have you guys go ahead and share, your background, bio, and how people can get in contact you. And if you specialize in anything specific, you can share
Can I
that.
say one more thing about selecting a preparer?
Absolutely.
Make sure they all have P10s.
Yeah.
Please make sure they all have P10s.
Yeah.
Yes, P10 is a ID number assigned to tax preparers. It's required by all preparers. So whether you are credentialed or not, you need to have a P10 to prepare returns and
Yeah.
for a fee.
Yeah, and I think you make a good point of the ghost repairers. Make sure that if you pay someone that they sign off on it, because
Yep.
it's illegal to pay them and then they don't sign it.
Yep, absolutely. All right, so Kamari, you're first. You want to go ahead and share your info and then we'll wrap up.
Right. All righty. Well, again, I'm Kamari Ellis. I'm the founder of the Philly Tax Team. I'm a tax accountant, former portfolio manager, reformed financial advisor. So I've worked in just about every asset of personal finance and small business. My specialties, I work with a lot of real estate owners and real estate investors. And I also started to work with a lot more of e-commerce, people that are using eBay, Spotify, things like that. That's me. You can find me anywhere as the Finance Rebel. That's my nickname. I did have a Philly Tax Team Instagram page, but for some reason, the Facebook/Instagram guys stole it from me, took it away for no reason. But you can always find me at the Finance Rebel.
Perfect. Thank you. Natia?
Hey everyone, so my name is Atia Brown. I'm a CPA by trade. I'm licensed in Canada and in the US,
Cool.
and I've been licensed for over 13 years, and I love all things taxes. So I have a goal to save my savvy family $1 billion in tax savings, and so we do that by creating customized tax plans so that they can solve their tax issues or save on their taxes legally. Like Kamari, I do work a lot with real estate, and so I have a lot of investors and agents and brokers. But I also help with tax resolution. So that's typically individuals that have small businesses. And so if you have tax issues, I would love to speak with you.
Thank you. Perfect. Perfect. And as far as myself, Safi Russell, in case you're joining late, CEO and founder of SDR Consulting, Inc. We specialize in helping business owners from the startup phase all the way through to tax planning and as they grow, tax preparation, and then as they grow, tax planning. And then for the ones who've made a mess of things, we can help with cleanup, get you back on track and back into that compliant and planning stage. We also do offer tax resolution services for those who've gotten in trouble with the IRS or state. So if you're looking to start a business, or if you have started and you need help getting things on track, feel free to reach out. At SDR Consulting is where you can find me, and as well by phone, 516-255-6603. So thank you again, Ati and Kamari. It's been great. I think this is really helpful, and we will be back next Friday. So Business Basics Friday, every Friday at 12 o'clock Eastern, with guest speakers to help provide value to business owners wherever you are. We do our best to continue this through tax season. So definitely set it on your calendar. We will be here. And this is a great opportunity to get your questions and answers for free from professionals in the industry. So don't miss out. Feel free to share the word. And thank you for your feedback. Ebony said this was very helpful. All right. All right, everyone. Have a great day. Stay safe. Happy New Year again. And I'll talk with you later.
Bye.
Bye-bye.